Welcome everyone to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do, thanks for checking me out. Like always, you can check me out on social media at EveryTimeICash. You can check me out on my website, everytimeicash.com. Feel free to reach out, everytimeicash.com/contact, or just directly Twitter, Instagram, Snapchat, whatever, at EveryTimeICash. These videos are for mostly entertainment and some educational purposes only. Please, if you need help financially, seek the help of a professional, not some random dude on the internet. And in this case, I'd be the dude. This is going to be a quick video about where we are in the market. A lot's changed since the last time we did a video. And so this video is going to cover Jackson Hole, where we are, what's changed, what are my thoughts, and so on and so forth. I try to do this in a little bit of a comic book motif just to kind of make it a little bit more digestible. But the first part's just going to be what I saw from Jackson Hole, like some of the main quotes from Jerome Powell in his speech. And then the second part, and very quickly, is just going to go over some of the levels and some of the things, some of the problems. So without further ado, let's just jump right into it. First and foremost, the first quote that I got from Jay Powell was, the Federal Open Market Committee's FOMC's overarching focus right now is to bring inflation back down to our 2% goal. So, like, first and foremost, this is out of touch with reality, right? So 2% is way out of pocket. We're not going to get 2% anytime soon. But it's important to note that because that's right off the bat, bang, where he started. And it just basically emphasizes that they're serious, right? So if you just remember the backdrop of where we were going into FOMC versus where we are today. Going into it, we had this, sanguine belief by people who invest and in traders and stuff like that, that potentially the Fed's going to pivot, right? So, if you listen to me, or have listened to me rather, you heard me wax poetic, like ad nauseum, saying, "Hey, there's no pivot here." Right? I don't see where the pivot's coming from, but just based off of how things were trading and the momentum behind it, there was this hopium in the marketplace saying, well, maybe Powell's going to pivot, maybe the Fed's going to pivot, right? And so right off the bat, just immediately, he just crushed that hope. And going to the next slide, you see, restoring price stability will take some time and requires using our tools forcefully to bring down demand and supply into better balance. So that was the first moment in that speech, because he used language, and I'm going to go, back up for a second, on record say, I didn't think he'd be aggressive. I thought this was just going to be like a softball, push it into September, and then they can get aggressive. But he, right off the bat, just bang, bang, over the head, just really quick, cratered any hope that they were going to be soft or accommodative of any kind. So going into it, there's going to be another video on my website, or on YouTube, before this one, that you could reference. That was a live stream from the morning of the Powell speech, and that morning, my belief, because that's the belief of the last 13, 14 years, is you get these hawkish Fed officials that don't vote, and then you get the people that actually vote come in and just kind of play superhero and save it, which is where this like comic book motif came from. But in this instance, he didn't. This was one of the first times in recent memory that I could remember where they were all hawkish in line, and it wasn't a situation where Powell comes in and plays the good guy, and the market just kind of is placated. So this is the first time in a while, in some time, where he just hits you over the head very quickly and says, this type of language. So if you just go, price stability will take some time. So right off the bat, he's telling you this is going to last longer than most people predict. So that pivot that people had in mind comes off the table, and it requires them to be forceful. So he's basically telling you, hey, strap in. What you think might happen may be less aggressive than what we actually need to do. And then emphasizes it and says that they need to do it, gives you the why of bringing demand and supply back into better balance. So he's right off the bat, second thing in a row, basically. So we continue. Reducing inflation is likely to require a sustained period of below trend growth. Again, bangs over the head and says, we're going to go below trend on the growth rate. So resets the expectations. Remember, going into this, people's expectations was or you would find people that say the economy is still strong, growth is still there, consumers still strong, et cetera, et cetera. And then he echoes, and this is an important part because it's part of their dual mandate. Remember, the Fed's dual mandate is to keep inflation under 2%. That's basically what they're telling you. Pie in the sky, whatever, but that's what they tell you. And then to keep labor force participation at its highest, right? So they want people to have jobs and they want inflation under control. And in this case, people have jobs, and we can argue about whether or not those jobs are keeping up with the rate of inflation and wage growth is keeping up and productivity. We can argue about all that stuff. But the reality is we have the highest point of labor force participation since COVID. So people have jobs, but in this case, he again hits you over the head with a mallet. Basically says there will very likely be some softening of labor market conditions. So he's already setting the expectation. I took some notes on this while after I listened to it, read it, whatever. But my takeaway here is one of two things. So one, he's resetting expectations and telling you, hey, get ready, winter's coming, whatever. But also, I think this is kind of like a nudge to the people that make the decisions on hiring to basically just give them some sort of visibility so that they don't overhire, so that you don't see any sort of repeat hire fire type thing. So it kind of tables that side of the equation. So if I was considering hiring people because I thought maybe things would get better or maybe we're getting to this point, this language kind of reiterates to me, hey, back off, cool off, wait a second, right? And so let's just continue. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. Now remember, Powell on multiple fronts would cite the strong consumer and strong demand and households are fine and businesses are fine. This is the first time where he basically says, you guys are fucked, right? And so in this instance, he's very explicit about saying that there will be pain to the U.S. consumer and to businesses. So he's being, again, if we go back, he's signaling to the people that hire, hey, there's going to be some softening in the labor market conditions, and this could be a self-fulfilling prophecy. And then in the next instance, he's telling them that there will be pain in businesses. So he's already signaling to them like, hey, if you wanted to hire, don't. If you thought things were going to be good, don't. There's going to be more pain. And so he goes on to give you the explanation. And this is, I thought it was important because he says there is a historical record that cautions the Fed to strongly against premature loosening policy. So he went back and he cited Volcker and he cited some of the things that happened in the past and basically echoed and stated that they have to remain firm and vigilant so that they don't do things prematurely, so that you don't have these stop starts in inflation expectations and in inflation in general. And so I wanted to emphasize these points because it paints a completely different picture than what people had going into this meeting, right? So going into this meeting, people were thinking maybe things are not that maybe the Fed will pull it off. You'll have this situation where you'll have a soft landing, a turbulent soft landing, whatever, but they will be able to pull it off. On the back of this, it really reframes the narrative. It really reframes everything. It stops that that notion and that belief. And this is important, and I'm going to stop on the slides point here for a second, just to kind of illustrate where we are from a market perspective. So this is just the S&P E-mini futures on your screen. And here's your June bottom. We've been in this slight uptrend. We got right up to the 200-day. At the 200-day, I believe it was about 10 or 11% from an all-time high. And, it gave you just enough hope. It gave people just enough hope to think, hey, maybe we can get through this. In particular, Apple, let me just pull that one up. Apple came within 4%, I believe, of an all-time high. And it came right up against this downtrend, and it failed. It's about as picture perfect as you're going to get. So let's just go back to the E-mini contract. So it's in this uptrend from June, and then it, a month later in July, and here we are, September 1st, test the trend, whatever. I want to note that we, since the middle of August, have hit on a short-term basis oversold conditions, and we hit, we had 5 days of percent of stocks above their 10-day moving average in single digits, in low single digits, like 2%. That's oversold. We had stochastics basically read oversold, and we had a couple of other indicators essentially, read to us that we were in oversold territory. In particular, like if you just take a look at Tesla, for example, I think Tesla had 1, 2, 3. So it had it had 6. It was on the verge of having 6 consecutive red days in a row, which was like the most since I think it was the most since 2020. So all these things, like just from a technical perspective, line up to give you this uptrend. And in this case, like in Tesla's case, you have the 100-day, you have the 50-day right there. And going back to, the S&P, you have this uptrend. It's below all of its moving average, but you have this uptrend. But it all sets up for, this push-pull between momentum, which is what we had since June. Because if you go back to June, and if you've watched and listened to what I've been saying, you had this peak bearishness in June, and on the back of it, the market didn't sell off, right? And so in this instance, so if you just go back to June, let me just pull up oil. In June, you had oil futures rallying back to the highs that they set on the back of Russia-Ukraine. You had bearish positioning be the most that it's been in like 20 years. And you had this, extreme pessimism about 75 basis points and 9% inflation. So the backdrop in June was very bearish, and markets stopped going down. And now we had the opposite, right? So we have the opposite where people were starting to be, a little bit passive. You had this summer doldrums, basically. And if you just go back and listen to some of the things that we said back in June, it's pretty much played out exactly as we expected. We expected that bearish positioning would be caught off sides, and that we would get a couple of improved CPI prints and improved inflation prints, and we would have this situation where you'd have these stop starts and you'd have these extremes. And so we had the tumultuous first half, we had a summer rally, and now we're setting up for the fall reality, right? So tumultuous first half, up, down, sell off, and then summer begins, people are off sides, we rally, and now we're coming up on this reality. So the backdrop has changed. Powell is signaling to us now that the Fed is going to stay aggressive as long as it takes to bring down inflation and to bring back price stability. That's something that he's saying. The reality of corporate America is starting to hit as well. You're going to see more layoffs coming into the fall and into the winter potentially. You have inventories building up at historical paces, and you have consumer demand coming in as well. So you have this Molotov cocktail of just bad confluence of events. And on top of it, you have geopolitical uncertainty in the face of Russia, Ukraine, and energy prices in the face of, Russia kind of strong arming Europe. So all of this stuff leads me to this last slide that I had, which is the Goldilocks scenario, right? So Friday morning, we had markets open higher on the back of this mixed report from, the job market, or the jobs report, excuse me. So it gave bullish people just enough to be bullish. It gave bearish people just enough to be bearish. But it get used to I said it on Twitter, and I said it, on Spaces and all that stuff. Get used to the term Goldilocks, because, when I first started, like, really trading was during the housing situation, and you had just over and over again CNBC, Bloomberg, all these guys just bang you over the head with Goldilocks, Goldilocks, Goldilocks. And I just want to say, Goldilocks is Goldilocks until it isn't. Sounds like a nothing, right? Sounds like me saying it is what it is. But essentially, like, you're going to get these mixed readings, and you're going to have enough people still stay bullish, and you're going to have enough people still stay bearish until reality sets in. And the reality is Goldilocks is unrealistic. The problem is the Fed's hiking in a historical way. They're hiking later than they should into a historically levered system, and that's debt to GDP. Inventories, again, are spiking, and demand is softening. So demand was already softening because, we've been locked up in our houses for 2 years. Everything that we want to buy, we've bought. In summer, there was this rush to finally do stuff. So you had the service side, really catch a tailwind when people wanted to go on vacation. They wanted to go to Disney. They wanted to do all this stuff. And so now the reality is, will that continue? And hey, maybe it does, right? Like, maybe we're just in this weird situation and everything works out. But the probability of that gets less and less and gets worse and worse, because ultimately the Fed is responsible for money supply, right? And so the availability of money drives economic activity, which drives earnings, which drives the economy. And essentially, if people have less access to money, they have less access to buy shit. And if they have less access to buy shit, then earnings suffer, and then ultimately the economy gets worse. And that's just as simple as you can make it, as simple as you could read it, and as simple as you can think about it. And so now that we know that the intent of the Fed is very clear, so if we just go back, just look at some of the stuff he said. Historical record cautions strongly against prematurely loosening policy. So hey, they're not gonna just soften up anytime soon, is what he's telling you. They're telling households and businesses that in order to bring down inflation, they have to be aggressive, and that ultimately will cause pain. He's telling you reducing inflation is likely to require a sustained period of below-trend growth. So all of this stuff is being telegraphed, and he's being very clear. So this concept of like a Goldilocks scenario is just pie in the sky to some extent. And hey, I'll tell you, maybe I'm wrong. Maybe it'll actually happen. But it's just a probabilistic event, and the probabilities of something like that are dampened. And so when you think of this stuff, and when you think about these things, and you look at these trends, right? You notice that if you just go back to Friday, for example, any minor thing or less than major thing can give you a hiccup. And in the case of Friday, you got that headline from Gazprom, and boom, markets rolled over very quickly. And so it's very important to just have this framework in the back of your mind, and just kind of understand that sometimes it's where you are, or it's where you were and where you're going, and sometimes it's where you are and where you could potentially go. And when the Fed is being as aggressive as they are, when you've got geopolitical uncertainty, when you've got a consumer that's going to start feeling some pain because inflation isn't going to 2% anytime soon, and you have unrealistic expectations by investors, it really gives you a setup for a very piss poor outcome. And so with that in mind, I wanted to to illustrate this and just kind of bring it to attention. So we'll just, from a short-term perspective, understand that we might be oversold or like, looking for a relief rally. But just understand that you've got lower, you've got from December, this is December 29, 2021. You ultimately create a lower high in March and you create a lower high in August. So ultimately you could go up, right? Like we could see some relief on the back of some of the stuff that we've seen here lately. But these relief rallies that we see in a downtrend, just from a technical perspective, lower highs, lower lows, opens the door for us to just be like unwinding longs or potentially setting up for further downside. And as things get potentially worse in the fall, like they're going to meet in September and they're going to hike, and more and more people are going to be behind benchmarks. Could see a situation where this stuff just kind of unravels on the back of midterms, and at that point, you could start to potentially think about the pivot. But until we start to see some of this stuff come through, whether it's earnings revisions or whether it's just inflation expectations and whether it's the consumer, until you start to see some of this stuff kind of weather out a little bit, it's too premature to ultimately look to bottom fish and to say that things are going to be okay. So I just wanted to make that video, wanted to make it very clear. Just get used to Goldilocks. Just understand where you are and where you're going. And I just want to say thanks for watching. Thanks for your time. As always, please like, comment, subscribe. Leave me a comment if you found this useful. If you didn't, that's fine too. And as always, please stay safe, stay profitable, and stay locked in.